Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. I'm joined with the usual suspects, Costa and Eva. How are you guys?
Good, Julian, and yourself, mate?
Pretty good. I mean, it's rate day. So
Yeah, it's always a fun day,
it's
isn't
always
it?
come in like, what's going to happen today? Obviously, I don't think there'll be many surprises. We are, of course, recording before the decision. So I don't want to be digging too much into forecasting because we'll 100% get it wrong, won't we? But I think overall, we can talk about the trajectory that the housing market is taking off the back of that, right?
Housing market is slowed a little bit. Auction results again aren't the prettiest. They're better than last week.
But we had a holiday last week.
But there was a long
so,
weekend last weekend. But it's pretty much been the same as it has been the past month, which is in the 50s, low 50s at that. So, it's
an uncertain time. And obviously we're at 4.35%, which is pretty significant. I don't think any of the banks are forecasting any kind of cut until at least 27. And then they are seeing it come down. So I guess there is some hope for borrowers on the other side, right?
Yeah.
I think people are starting to see the market as it is now as an opportunity.
Yeah.
I can see the shift a little bit in the discussion that I've had with clients over the last week or so, where people are like, well, maybe it's time actually that I get in.
Yeah.
I might get a bit of a, discount
There's that always
somehow.
elasticity of, goes to a buyer's market, then it goes to the seller, and then it kind of...
that's right. But mind you, I've had clients going to auction and actually winning auction at a price tag in Sydney that was a lot higher than expected.
Yeah.
So what you read sometime in the media and the reality of them going there, it's like, we actually spent 200 grand more than expected.
Oh, wow. Yeah, that is interesting.
Obviously there are markets where scarcity in type of property is still going to be,
But you are still seeing a quite damp market, preliminary clearance rate below 55% for a third consecutive week. And as we said, last week there was obviously the public holiday, which have weighed on that. But combined capital's solid 80.8% bounce back in auction volume following the King's birthday. But we're still seeing 54% of capital city auctions recorded a positive outcome based on the results collected to date, which was yesterday. A modest step higher from the 51% that we saw a few weeks ago, but it's still not quite where the sellers would want it, is it?
In the end,
still a buyer's market, but that's where people that are maybe a bit ready for it will jump in and seize opportunity.
Well, we're saying, as Eva was saying, like one of her clients actually had to pay overs for the property at auction. And when you listen to the media, they talk about the housing market as a collective.
Yeah.
It's not. Like, obviously, you can separate them by different states. Then you can separate them by different regions. And then, say you got Sydney's one region, and then you can separate it by suburb.
Yeah.
There's so many aspects and different things at play that to put it all into the one group to say that housing collectively is coming down, it's just not true. Listen, it is coming down majority of places, but there are still some places and plenty of them that are going up. Yeah,
there are always pockets. And I mean, I remember we looked at the map last time we were on, right? And there was that, cities like Sydney and Melbourne where, the overall headline is, they're in regression, the prices are dropping. And then you see the map, you go, well, the prices for most people are not dropping. It's just certain
or where
suburbs.
people can afford to buy, it's not dropping. Yeah.
And this ABS statistic that you've got here, I mean, you've got a 20-year growth of 216% in Sydney. That doesn't seem like a terrible investment. But I'm interested to ask you guys, so obviously with the rate on the way today, how much is this kind of higher rate environment weighing on investors right now? Is that one of the main things that is influencing their behaviour, or is it more budgetary?
The budget as in, the rates had a big influence, let's say 6 months ago when it started, a bit more now, in borrowing capacity. So that's one thing, the capacity dropped in what they could buy. With the budget now, there's no more negative gearing on existing property. That will drop again the borrowing capacity. So it has pushed investors that still want to buy established properties in very specific suburbs where they can still afford to buy something, and maybe also units will pick up a bit because that's where they can buy. So there's a huge, there's a huge influence on that. And that's where we might see as well from the ABS data, the cities that haven't picked up that much, or not as much as the others in the last 20 years.
Yeah.
That's where the price are going to be lower. That's when people
Well,
might be
Darwin
able to
being
buy.
one of them, a lot of buyers agents are now going towards Darwin. And just looking at this,
Yep.
it's gone from 340 in 2006 to 750 in 2026. So it's fairly reasonable pricing still up there.
And there's still room to grow, right? Like with
Yes.
the one thing we've kind of seen, at least as we say, it's varied, but with Sydney at least, is that maybe it's found its roof, and some units are not going to push much higher, or at least see that exponential growth that they've seen in years gone by.
Yeah. So, but you can see like Perth might have still some fuel in the tank.
I think,
All right. Darwin, obviously, lowest there. Melbourne might be the next that that picks up.
This ABS data gives you that kind of long-termism that sometimes you can miss when you just focus on the totality data each month. That you always see Perth going absolutely gangbusters, but then and I kind of see the Sydneys and the Melbournes not quite as. But obviously, for most investors, if you've got in, then they're really valuable assets to still.
Correct.
Well, in those 20 years, I think the GFC was 2008.
Mm-hmm.
So in that
we're
20
just getting into that, yeah.
So we've had the GFC within this. We had COVID within this 20 years. So there has been some bumps along the way, as there always will be with each 20-year sort of portion. But when you look at it over a 20-year period or even 10-year period, it's always going to go up.
Speaking of bumps, so we did some stuff on Equifax data that shows that mortgage demand, even in first home buyers and owner occupier, which usually a good underlying part of the market, has seen a pretty sharp deterioration in 26. So it shifted from 10.7% annual growth in January to a 0.9% decline in April and 6.6% fall in May, which is, I mean, that's a decent bump, right?
That is,
there's multiple factors that are kind of contributing right now, and obviously it's not the first time that this has happened. But what's your guys' take on that? Is that just the uncertainty right now, or do you think it's projecting something a bit longer?
Affordability as well. I think a lot of people would want to get in, and they're just a bit stuck in terms of servicing capacity. There's so many scheme and help from the government. Like if you really wanted to, you could, right? It's just I think they feel a bit stuck. And I do have clients that are like, well, yes, you can borrow 600,000 or whatever it is, and they're like, well, if I do that with the repayment, I don't actually know if I would like the life I would get from that.
Yeah. I have to sacrifice the lifestyle.
Yeah.
And well, if in January there was 10.7 annual growth, like that just there shows you that there is people that wanted to get in. And then as it's gone down, you can probably contribute that to interest rates obviously going up, and then obviously all the stuff with the government and everything. With
we had
budget.
record numbers of first-time buyers going in.
That's what's strange is that, just a few months ago I was writing about how first home buyers are surging, and that part of the market, I guess the part of the market still is surging, that lower end. But slowdown, I mean, so first home buyer mortgage demand down 16.2% in Queensland, 15 in Victoria, 12 in New South Wales, 11 in South Australia, and 8 in WA.
Yeah,
so
wow, it's double digits everywhere.
It's pretty strong everywhere. And you've seen, 26 to 35-year-olds seeing the steepest decline, 16.3. And I guess, again, that might be some cultural shifts there of what people are after. But it's also, I guess, as you say, reflective of kind of the serviceability there as well.
Yeah. And there's a lot, of I want my cake and eat it too. I think people,
for sure,
I just want the house, but also going out every weekend and going, twice overseas, and I get it. It's hard to make a decision, especially when you have kids. It's like, well, if you do buy the house, well, you'd have to spend your weekend in that backyard of your house if you get a backyard, because it would be probably tight. And then if someone loses their job or they have a more, casual or part-time situation there, if something goes wrong, I think it's a big weight on your shoulder to take the plunge.
And then that's where you've kind of seen, and I will get into this in later in the episode, but we've seen kind of both governments and banks kind of trying to give something back to make it a more attractive prospect. And obviously stamp duty is one that kind of comes to mind right now, of trying to kind of change that playing field so it's even more, weighted one way that it looks like an attractive prospect, I guess.
But it's a stressful time for a lot of people at the moment. Interest rates are high, cost of living is very high. There's a lot of uncertainty in the market, and if you're going to commit to a $1.5 million, $2 million home, you know, like you're going to have to sacrifice a bit. Listen, there are some people that don't need to sacrifice because for them that's fairly easy, but for the vast majority, they will have to sacrifice something within their lifestyle to be able to purchase that property and to make sure that they're in a position while we get out of this sort of economic downturn, uncertainty period, which...
Do you see this with your own owner-occupier clients, that they are more hesitant to move forwards?
I've
more,
even
more
got,
so than the investor clients?
I've even got investor clients actually counting numbers now.
It's a cash flow issue,
More, I've noticed a bigger uptick going, what are my repayments like? And then they'll go back and do their calculations on, you know, how much they're going to have to fund for the property now that negative gearing's gone and, you know, interest rates may go up. Don't think they will, but again, cost of living and just all that sort of stuff, uncertainty. So, yeah, there is, you know, before it used to just be cool, let's get it done, let's go for it. Now, I wouldn't say hesitation where they're not going to go ahead with it, but hesitation in the sense where they sort of just want to think about it a little bit more.
Yeah.
And sort of take those extra few days to go, you know what's this going to look like compared to just get it done.
Yeah, absolutely. And I guess that does kind of overall, you know, you're seeing this decline, that does feed into the kind of the business for brokers as well, that, you know, there are less people that are, you know, currently after mortgages, which means there's kind of less business to write, correct?
Yes and no. I think there's a huge opportunity for refinance. And, you know, a lot of investors that have portfolios already are looking to refinance all the loans back to 30 years on interest only 5 years to free up some of that cash flow. And that might actually help the servicing capacity for the next property as well. So while we might have less first-time investors or, you know, investors looking to buy and buy again, there's people like shifting the mindset on, okay, what can I improve in what I have currently to set myself up better for what's coming. So less business, I don't know, it's just different business.
Right, yeah, absolutely. Guys, we better take a quick break there, but back in a moment. Welcome back, guys. Broker Daily Uncut. Now, before the break, obviously, we were talking about some of the slightly gloomier elements of the market, but something that came across last week, which I thought was, you know, excellent news, was that broker share for the first time has gone above 80% market share in the mortgage market, which is pretty amazing considering how quickly that's grown. I think even in November it was hovering around 77%. And if you go back a few years after that, it's way lower. So I mean, it's really surged. These are MFAA figures. So yeah, 81%, guys.
That's good.
How does that feel?
That's a good thing, yeah.
It should be more, actually.
Yeah.
I think.
That's what I'm interested in, because obviously that begs the question, kind of what next?
Yep.
So obviously a big kind of avenue that brokers are looking at now or are already in is obviously that commercial lending.
Yeah, I think we picked up a lot of first-time buyers.
Yeah.
You know, that they go to a bank, they just feel a bit...
What do you think's driven that?
I guess they need their hand held.
Yeah.
They don't know the numbers.
But why do they need that more than, let's say, 20 years ago?
I think it's harder.
People don't have a relationship with the banker anymore.
Yeah, like...
There's no branches anymore. There's no...
Yeah.
So...
And I guess the components are different. People's contexts can often be more complicated. There's obviously lots of schemes. Obviously, there has been schemes in the past as well. But I guess there's a lot of different kind of moving parts. And it's free.
It's free.
Yeah,
so
well,
why not?
and again, like going into one bank, they're only going to sell you their product. And in the end, they're salespeople.
Yeah.
They're going to sell you their product. Whereas again, if you come to a broker, we've got everyone on our panel. And then, I don't know about you, but like, is there such thing as a sort of vanilla deal these days? Like there's always an issue with something, be it some hex debt or, you know, like say someone like NAB, if you've got 20 grand or less in hex debt, they'll exclude that. But if you're going to Commonwealth Bank or St. George, you wouldn't know that NAB have that, and that may increase your borrowing capacity for a first home buyer. So if you're going to a mortgage broker, you're going to find out about all those little niches.
Yeah, you really maximize
and you don't get that
your-
expertise as well, right? Like I did an article this week basically saying, well, what comes next and why has it gone there? And a lot of the brokers said to me, like, you know, you can look it up and it will tell you X, Y, and Z, but only when you talk to a broker will you actually be able to unlock the potential and all the kind of aspects of the loan, the X, Y's and Z's that make the context so crucial. And that was a really interesting part. You know, they said it's not just you can write a loan with anyone, but you're not going to be able to.
Yeah, and that's what we're here to do, is to assess your situation and find out what best is for them, be that with a NAB or a Macquarie or a second-tier lender.
And to pick up on what you said just then, another thing that they kind of noted was that you're often getting more young people. People are more financially switched on. In the past, potentially it was more, okay, well, I've always banked with X bank, so therefore I just walk in and get a loan with them, right? As if now I think people are more aware of the fact that they might be a better deal somewhere else, or there might be a refi.
And they just don't have that relationship with any banker.
Yeah.
So they would start literally on the internet.
That's very true.
It's comparing stuff and be like, oh, here's this mortgage broker, I'll have a chat to them. And I think we start with that. There's obviously we're running more commercial lending now.
Yeah.
And I guess the part that's missing, 20%, would be, I would guess a huge part of that would be self-employed people that actually have relationship with bank for other lending purposes. And obviously they do have that relationship with, Joe at the bank. And it's like, well, Joe, can you just write that as well or buy this? Then it's easier for them to do it that way than coming to a new broker and having to re-explain the whole situation. When it gets complex, it tends to stick somewhere. It might not be for you, in your advantage, but you tend to do that.
Well, there's 19 percentage points left.
Yeah.
well, there's 19% that we can get.
They will be
still.
hard. Yeah, they'll be hard fought, right? Because obviously, when you go through every bank, every major bank at least, kind of outlook, they're proprietary. Let's focus on proprietary. Let's try and get it up. But what you're seeing in the market obviously is different to that.
I mean, some banks also are pushing brokers to write loans for them.
Of course,
So it's not like they are losing doing this.
Many are investing in the broker channel, right?
Yeah,
and they get the loans.
Yeah, so it's not like they're losing by
products.
doing this.
Yeah.
The client is always going to be the winner there.
What do you think there's any kind of pitfalls? So obviously, I think one of them is obviously that kind of compliance side, fraud side, like this is hard-earned trust that's brought 81%. What do you think are the kind of pitfalls to going any higher? Is there?
Good question.
Yeah. I was going to say maybe the higher you go, the more compliance and, you'll start being assessed, like not assessed more, but like, the
but then it's
sort of governing bodies
sort of kind of pushed it up because, I mean, out of best interest duty, it suddenly meant consumers could go, well, this person legally has to work for my best interest. So this is an obvious thing to do, right? So it kind of helps in a way. It doesn't.
Yeah, it's a good question. You got me thinking about that one.
I think as it gets more complex, and then new schemes, new way to buy things, stamp duty exemption, this and that, people do need the expertise and will come more to talk to brokers. You're always going to have a part that just sticks with what they know and the branch next door. But that's okay.
Yeah.
That's okay.
See where it goes next. Well, obviously the MFAA released that, and then kind of on the other side of brokers kind of making their voices heard, we've obviously got the budget. We've been talking about the budget for some weeks now, but the first tranche of the budgetary changes passed House of Representatives 5th of June, and now it's in front of the Senate Economics Legislation Committee that's scrutinising it under new fast-track rules. With
how convenient.
Hearings were yesterday.
2 business days to go through all this.
15th, 16th of June. No broker groups were invited to that. But doesn't mean that kind of things haven't been happening behind the scenes. So they want to pass it before the 2nd of July, before their winter recess. I'm looking forward to my winter recess.
When is that coming?
Do you get 6 weeks off like them?
I hope so. I'll talk to my boss. But behind that, obviously, there have been a lot of submissions, and MFAA definitely was a big voice in that. They wrote a mammoth submission, kind of like picking apart every part and kind of seeing how they could kind of do it better. And it's definitely reconsidered, urged the government to reconsider elements of CGT and negative gearing. They said it could kind of, first home buyers aspiring to buy through kind of managed investment shares, they could be undermined through this. And there's different kind of property investments that the changes could really affect. Go onto the website to read the whole kind of analysis of what they're saying. But it's really interesting kind of seeing that they, this structured kind of takedown of, past the emotion of saying, well, where these are the points where it's going to impact incentives in the wrong way, which was a important part of it, I guess. And we've talked about the way that incentives could be disrupted. I mean, sometimes for better or for worse, right? Like we'll see where it goes, particularly among investors. I guess they're taking a step back and having a look. But I never really thought about the kind of owner-occupier side of it. That
they're not happy either.
Yeah.
That's what's interesting.
This is meant to be their budget.
Yeah, and they're not actually, happy with what's happening.
Well, if you go back to the first segment that we did, home buyers
down.
They're down.
Yeah.
Aren't we meant to be helping them?
Yeah. I think there's another attempt to not address supply and just go for
we've said it a million times. The thing that they've got going on now, it started Monday morning, finishes Tuesday afternoon. For something that big of a change within government, I don't think a 2-day sort of conference, whatever you want to call it, is anywhere near enough. Like it's one of the biggest changes in the tax system for like 20 years. So, and you're having 2 days to discuss it. That alone just tells me like it's basically just, they just want to get it through and be done with it.
Yeah.
So,
I mean, they have talked about, I remember another piece I did with HIA, they were talking about how there could be carve-outs in negative gearing, because they basically said the definition of a first home is of a new build is too narrow, and it will kind of suddenly renovating your home, suddenly doing different things with existing stock, which actually could be really beneficial to supply, is no longer incentivized.
We've had some clients as well buying properties thinking it is considered as new build.
Yeah.
And it was tricky. Like one of them was a display home.
Mm-hmm.
One of them, I think, was building a granny flat at the back or extending.
Granny flat, I think it was.
Like it's tricky, and even the banks don't know what to do with it.
Yeah.
Yeah, you speak to them and they're hesitant. They're like, oh, let me come get back to you. So,
Well, I see it in the wording, because it'd be worth saying as well that
it's not gone through yet, so...
Yeah, it's not gone through yet.
So what?
So it'll be interesting to see what comes out of this, because I've seen a few that I did. I reported on another look at another submission, and they were basically arguing that it needs to be kind of phased in if you're going to do something like this. To do it straight away will have such an impact on the market.
And I think the carve-outs referring to more startups.
So that's the other side of it, right? Obviously you've got this side of the kind of property investment, negative gearing, obviously capital gains tax plays a part in that, but then there's the capital gains tax on small businesses and how it's going to affect startups. So we've been doing a lot on that. There's a broker who's been there's 2 brokers met with Angus Taylor, opposition leader, Joseph Dowd and Julian Barnes. They were basically looking at this topic and saying, we haven't been consulted. We don't know the business that have been consulted, but fundamentally it could change the whole entrepreneurial spirit of Australia. That's 100%. Their argument. And they brought a huge contingent of different business owners. There was a 17-year-old girl there. There was, someone born abroad that started a business over here. And they kind of had all the same concern of like, what is this going to do in the future for businesses, and if you're successful in Australia or take a risk, how does it work?
Oh well, the Australian government becomes a shareholder basically, and they pour hundreds of thousands, even millions sometimes into these businesses, and you go to sell it and sort of cash out, but 47% of it's just going to go to the government, and then you just think, well, is it worth it doing it here? Maybe I'll go to Singapore, New Zealand, where capital gains is.
Yeah.
And another part of it for brokers at least is your loan book is obviously subject to this, and come retirement that's a big hit, right?
100%.
If it comes under the jurisdiction, then that's a big hit. Especially if it's a larger loan book, you're going to see a completely different kind of world of succession and how that's going to work on the other side as well.
Yeah.
We'll have to work a few more years.
Yeah.
You ain't going anywhere anytime soon. Guys, we better take a quick break there, but we're back in a sec. Welcome back to the final part of Broker Daily Uncut. Now, obviously, behind the scenes, we've been kind of seeing this. We've been talking about the kind of contours of where the kind of housing market is going right now. And we're seeing a kind of downturn, but that doesn't mean that there's not parts of the market that are looking more and more attractive. And one part of that is, of course, stamp duty changes. We've seen a few go through. We've seen kind of states kind of tweaking them, trying to see what they can do. In the past, obviously, we talked about the issues that kind of first home buyers can potentially face when purchasing a home, because obviously house prices go up, and as the 5% deposit scheme caps move upwards, you're starting to bump against that stamp duty as well. And I guess it's something you have to talk to people about. What? I have to pay stamp duty as well? Like, I thought I was on a 5% deposit. But obviously recent state budgets have taken some different approaches to this to try and kind of shape house buyers' behaviour. So the first one we can look at is Australian Capital Territory, ACT, is going to abolish stamp duty entirely for first home buyers with no property value or income caps, which is a national first.
Yep.
I'd say
you'd be cheering if you're an ACT.
You would be, yeah.
It's great. I think the prices haven't moved that much there as well.
Yeah, no, they haven't.
So it's like, is it playing with fire again?
Yeah.
A little, yeah.
No, it's true.
Next
like
week,
it's,
Broker Daily go, oh, look at the state of
and it's not just for first home buyers. I think there's pensioners as well.
Yeah, pensioners,
Yes.
And
NDIS people.
And
eligible recipients, NDIS recipients,
or people
and buyers.
haven't bought properties in the last 5 years or owned properties in the last 5 years.
Oh, so there's a really wide set of people there.
Yeah. So I guess, people are going to start buying again and price go up.
Yeah, that's what they're after. Wow.
I don't
That's
know.
not what they claim to be
But
after,
that's what's really hard. Like every time you tweak something, it has its effect and its opposite right at the same time.
But they're for owner-occupiers and investors?
No,
Owner-occupier,
yeah.
No, non-investors there.
Yeah, investors still have to pay. But I mean, Tasmania moving kind of the other way. It's removing its existing first home buyer exemption, with all buyers returning to standard rates by 1st of July.
Yeah,
so it's a very different approach.
It would be interesting to know what made them go backwards.
Yeah.
Has the price picked up there too quick, or when did they actually
I know
implement
supply
that?
is an issue, but it's an issue in every
In every
state,
everywhere.
so it's not.
Yeah, it's quite interesting. They're moving back.
Yeah. Is it
Maybe.
revenue raising?
Yeah, maybe it is.
Well,
Missing out
I
there.
know they're not. I know with the whole AFL thing, that with the stadium, that they were complaining that they are in deficit quite a bit. So maybe it is revenue raising down there, where they're like, we need to raise some more funds to get this over the line. So
Yeah, absolutely.
For
Be
stadium.
And
First
it's
home
always
buyers
more
can pay for our
challenging having
stadium.
a-
yeah, well, pretty much.
Having a
It may not be
smaller
the stadium in
population.
general, but like just in general, like they're
of
in
course.
the red. So
Maybe first home buyers should get a free season pass or something.
Yeah.
What an incentive to buy a house.
yeah, like you would think that it would be a revenue raising exercise. Otherwise, if you didn't need the money and it's
Yeah.
a good policy to have in play, why wouldn't you just leave it?
Yeah, absolutely. And then I'll run you through some of the others. So WA, I think this happened a few weeks ago now, but it's moving to remove its concessions by lifting the full exemption threshold for established homes to 600k and inducing a 75% stamp duty rebate for eligible off-the-plan purchases. So again, you can kind of see them. And WA's been doing a lot of this, I've noticed, is basically trying to use policy to try and push investors and also first home buyers and owner-occupiers in the right
Or
direction.
even developers.
Yeah.
I think they've got that. There's a tax break if you develop
Yeah, they had
certain amount of homes. or
tax
something
break,
like that.
build to rent. They've had tax breaks for. They've got the pre-sale guarantee that they've started, which kind of helps with. They're basically trying to just funnel as much as they can towards developers to try and kind of incentivize them to put shovels in the ground. I guess is the.
But that's
is
probably
the plan.
what's going to help moving forward in long term, which we haven't seen in other states. So WA has been very busy in the last few years in terms of price growth.
Yeah.
So
Absolutely.
it'd be interesting to see if that, they're probably the only one really addressing the supply issue.
Yeah, 100%.
See if that actually
Yeah.
does something.
Exactly. And I guess last but not least, before we finish off, South Australia, kind of similarly, they've done a few things. So one of them is they're abolishing stamp duty for over 60s looking to downsize, which again is kind of, let's look at how many rooms we have in the state rather than...
free up some space.
Yeah, I think it's a good thing. We'll talk in off air that why do owner-occupiers, when they want to buy another property, still have to pay stamp duty?
Yeah, maybe this is a sign of things to come. I mean, I did a piece a while ago. The Liberal Party in South Australia wants to phase out stamp duty entirely. The revenue impacts on that would be pretty big. But
they must have a lot of money.
It's an interesting idea of, you know, trying to move the house market. And obviously, if we see conditions like this continue, like there will be more looks at like how the housing market's going to change. So I guess watch this space, I guess, is the thing. Stamp duty is definitely a live issue. It's
it's a big
moving
cost.
from a 2D kind
Huge
of
cost, yeah.
You know, what, a $500,000 property, you're looking at what, $16,000-$17,000 in stamp duty?
Yeah,
It
depending
is,
on
and
the
it's
state,
never factored as heavily into kind of the overall.
No, you always
pricing.
sort of forget about it.
Yeah,
And then they're like, oh, stamp duty.
they do that on purpose.
Yeah, well, that's it. But yeah, it's a big cost, and you know, it's more savings that you need to do, so
Yeah. I think it's the issue of also like pensioners that say selling their property, they have the cost of selling,
Yeah,
then the cost of buying it. They just can't be
absolutely.
bothered. So you've got like an old guy or lady just living in their 5-bedroom house
yeah.
But
forever.
why? Because you're getting penalised to leave. Otherwise.
Well, that's
You're getting,
what it
you know,
is.
because
Well,
the
that's
more
it.
expensive your house.
Why would you? I wouldn't.
Yeah, exactly. Anyway, guys, we better wrap it up for this week. But thank you so much for joining me as always. Where can people go if they want to find out a little bit more about Finni?
Finni.com.au. Got a brand new website, sparkly.
I saw it. It's lovely. Yeah, it's very nice.
And then you can get in touch there, book an appointment with us to discuss like specific circumstances.
Ideal. Well, that's all from
Easy.
us this week. Obviously, brokerdaily.au if you want more news, features, and podcasts from us. Thanks very much, and see you guys next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.